Welcome to this explainer. Today, we're diving right into the intense volatility surrounding SpaceX's stock ever since its highly anticipated initial public offering. If you've been watching the markets, you know it's been a total roller coaster for this aerospace and tech giant. We're going to unpack exactly what is driving this turbulence, looking closely at the data and the drastically different narratives driving both the skeptics and the long-term believers. Okay, let's jump right in. Let's kick things off with the hard numbers. 50%. That is how much SpaceX shares have absolutely plummeted from their intraday post-IPO highs. Right now, they're trading right around the $110 mark. I mean, that is a massive haircut for a company that generated so much hype leading up to its public debut. So what does this all mean? It really brings us to the big question we're exploring today. Are we witnessing a fundamental collapse of the SpaceX thesis, or is this simply a healthy valuation reset? Answering this sets the perfect stage for the two heavily contrasting narratives that are completely dominating financial media and investor circles right now.
Let's get into Section 1, the first public earnings.
To truly make sense of this current market divide, we have to look at the upcoming Q2 earnings call, happening right after the closing bell. There is unprecedented anticipation around this, mostly because it's their very first as a publicly traded company. Think about it. For decades, SpaceX has been notoriously private. Now, for the first time ever, Elon Musk and his team are opening their books to the public, forcing the market to transition from valuing a speculative private venture to judging a fully transparent public entity. Moving right along to Section 2, the lockup expiration fear. Okay, so while everyone's hyped for earnings, the thing actually keeping Wall Street up at night is basic supply and demand. Right now, the public float from the IPO is a tiny sliver, under 5%. But there's a massive 20% chunk of insider shares. That is 911 million shares held by early investors and employees that are about to become eligible to be sold on the open market. That extreme imbalance is exactly what's driving this current price action. And this isn't just a one-and-done deal. These lockup expirations are going to cascade aggressively right through the fall. We had that massive 20% unlock on August 6th, and then boom, we're hit with consecutive 7% unlocks in late August, September, and October. This timeline shows exactly why traders are terrified of a prolonged, swelling supply shock to the stock. The public float is poised to essentially triple, creating immense downward pressure if those insiders actually decide to cash out.
Now let's look at Section 3, resetting the IPO hype.
So traditional finance folks are looking at this looming supply shock and basically shrugging it off as a standard correction. Executive Director Bill Daley actually pointed out that this drawdown is just a natural repricing of a massive cap table. He noted that we saw the exact same reset with Meta in 2012 and Uber in 2019, where both of them fell over 40% before the public market finally recalibrated. The argument here is that this isn't a failure of the business. It's just Wall Street stripping away that post-IPO hype to find a realistic baseline. And this right here is the absolute crux of the issue, the difference between private and public markets. See, in the private market, investors were totally fine writing blank checks for these massive long-term visions based on total addressable markets. But the public market, they demand execution. They want to see quarterly cash flow, they scrutinize cash burn rates across experimental programs, and they demand that the premium they're paying for emerging tech actually translates into sustainable, expanding profit margins. Just to give you an idea of how heavy this public market pessimism really is, short sellers are currently holding a staggering 32% of the publicly tradable float. Roughly a third of the available shares are actively being shorted. That's a massive, high-risk bet against the company's short-term price action, banking on the idea that those cascading lockups and intense scrutiny will drive the stock even lower. But let's flip the script. Section 4, the hidden AI compute engine. Let's dramatically shift gears here and look at the bullish perspective, because mainstream media's trader mentality is completely ignoring a massive revenue driver. SpaceX has quietly been building an Earth-based AI compute business that is scaling at breakneck speed. We're talking an estimated 6 to 8 times faster than their competitors. Their playbook is brilliant. First, scale massive GPU clusters rapidly. Second, use just a fraction of that power for their internal AI models, like Grok. And third, here's the moneymaker. Lease that massive surplus out to other tech giants desperate for compute power. The results? They're pulling in staggering recurring revenue. We're talking confirmed deals with heavy hitters like Google and Anthropic. This Earth-based AI revenue is hovering near an incredible $30 billion annualized run rate. And this is absolutely crucial because it immediately offsets the insanely heavy capital expenditures they need for their other ambitious space projects. To put that infrastructure into perspective, Estimates are showing that SpaceX might already have up to 1.5 gigawatts of compute capacity online. Let that sink in for a second. 1.5 gigawatts. This immense amount of infrastructure is really serving as the hidden engine behind their long-term intrinsic valuation, totally removed from the daily chaotic volatility of stock lockups. All right, Section 5, Starship and Starlink Fundamentals. Beyond all the AI buzz, long-term investors are firmly keeping their eyes on the actual space business. While day traders are sweating over lockups, the core Q2 fundamentals we really need to watch are Starlink's average revenue per user, or ARPU, Starlink's subscriber growth, and crucially, Starship's capital expenditures. The real fundamental question for Wall Street is whether Starlink's expanding margins can successfully cover the massive cash burn of getting Starship fully operational. Luckily for SpaceX, they're sitting on a literal mountain of cash. That $85 billion they raised during the IPO? Yeah, that provides a really comfortable cushion. This war chest secures the capital they need for both that aggressive AI infrastructure rollout and the wildly expensive rocket development programs. It basically gives them a massive runway, totally independent of whatever the stock is doing short term. And this capital paves the way for the ultimate long-term vision. It's really a three-step process. Step 1, get Starship flying regularly and reliably. Step 2, use that massive payload capacity to make Starlink bandwidth and user subscriptions absolutely explode. Step 3, the culmination of this whole roadmap, launching orbital AI data centers in space. That is the grand, multi-decade vision that the IPO was essentially built on. Which brings us to our final part, Section 6, valuing the long-term play. So we are left with a pretty stark contrast in the market right now. On one side, you've got this short-term noise, traders obsessing over timing these lockup expiration dates. On the other side, you've got the long-term strategy, investors completely ignoring the daily charts and instead building comprehensive 10 to 20-year valuation models based on the compounding fundamentals of space logistics and massive AI compute generation. Oh, and as a quick aside, while you're navigating all this, it is super important to filter out the noise, like those recent Wall Street Journal rumors about a potential merger between SpaceX and Tesla, or Tesla spinning off its China business. You can safely ignore those. Elon Musk flat out debunked them, calling the reports absurdly fake news. It's a great reminder to just stick to the verified fundamentals we've covered today. So, as the dust finally starts to settle on the IPO and that highly anticipated earnings call gets closer, I want to leave you with this question. Which of these two narratives makes more sense to you? Are you going to get caught up trading the short-term lockup noise, or are you looking at the underlying AI and aerospace fundamentals to invest for the long haul? Thanks so much for joining us for this explainer, and we'll catch you next time.